Well, hello everyone. This is Tom Marshall, Virginia State and Retirement Planning. It is the day after Labor Day. Hope everyone had a wonderful and restful Labor Day weekend. I wanted to make a video. I know it's been a while since we've had one, and I apologize. As many of you know, my mother has recently passed, and my son has been very ill, so I've been spending a lot of time in hospitals here recently. But I wanted to give you an update of what we're seeing in the markets and what that could portend for future performance and that sort of a thing. First of all, just to kind of give us an update, this is the chart on the screen here is a chart of the Dow Jones Industrial Average going back to the 22nd of January in 2018. And as of the close today, we closed today at 27,500. What's interesting is that from January 22nd of 2018 till today, you can see it up here at the screen, these different values up here. The Dow Jones Industrial Average is only up 3.3% in 33 months. So think about that, 3.3% in 33 months, essentially about 1% a year, unfortunately. And we've had a lot of up and down and up and down and then up, and this is February of this year, the pit of despair, and then here we are having a little bit of corrections right now. So the larger issue we're having here is that essentially in the last 3 years, the stock market has not made much progress either way. And so what does that mean going forward, particularly since we have an election coming up in the not too distant future? We're going to discuss that today. Oh, there we go. Well, the key thing today, and this is, so the last chart we looked at was the Dow Jones Industrial Average. This chart is the chart of the S&P 500. And this is before the market closed. But this is actually just for the most recent year. So this is 2020 in January. Here is February of 2020. This is the big decline. And then here we are back here. And what you'll notice, each one of these little lines is a day in the stock market. And what you'll notice here is at the end of August, we broke out of the highs that we saw in February of this year. Ran up aggressively over about 2 weeks, and then now we've closed back below. And so this can actually be a very worrisome thing. It's called a failed breakout. And essentially what has to happen here is that there's a little box here you see that about 3450 on the S&P 500. This is a key box that we have to maintain. We actually didn't close in the box today. It actually at the end, we had some selling at the close with funds. It looks like after hours we're back in the box. But essentially what happens is that typically when you see what's called a back test in the stock market, when you see what's called a back test in the stock market, you take out and go above the highs in the previous time period, which is from February of this year. And the max we really should see is kind of around here, maybe a little bit below the 3,400, 3,350 level, but this is about the limit of our decline. And if we start seeing a lot more decline, it means it could pick up speed, because it's called, there's an old adage in the stock market that says, from failed moves come fast moves. So this actually could be a failed move higher if it starts to unravel as we go into the election. Now, the problem is that we're hearing, as many of you have contacted us, and we've had this discussion, the issue that we're having here is that, again, this is politically, it's agnostic. I don't care who wins as long as we get somebody who's sane running things everywhere. Unfortunately, we don't have a lot of sane people left in either party. So unfortunately, what we're probably going to see is the night of the election, it is probably going to appear, according to Bloomberg, that Trump has won handily, because the people who go to vote are typically vote in person. Again, this is a gross generalization, but this is according to Bloomberg. Those people are more conservative, and so it's going to appear that Trump has won. However, the problem then becomes is that there's going to be a lot more mail-in votes. And if there are those of you who remember Florida in 2000, this could be something just horrendously crazy with all of this, because now picture 10 different states as all these mail-in votes come in and everybody's crying foul and fraud, and we may not know who the president is until January. And so I think the stock market is finally starting to realize that we could be in all sorts of problems because of that. And in realistic terms, there's going to be significant change tax-wise if the Democrats take both the White House and the Senate. Now, again, I'm not for or against any candidate or party here. I'm just going according to what the Democrats have said, is if they take over the White House and the Senate, they are going to rescind all of the Trump tax cuts. They're going to reinstate estate taxes in a different way. They are going to provide Medicare for all, including illegal immigrants. They are going to have a reimbursement fund for student loans for those people in our society who thought it was a good idea to get a degree in medieval French literature and don't want to teach. And then they've also talked about there's going to be a plan for reparations. And so what the markets know is that somebody has to pay for that. And when taxes go up, the stock market typically doesn't do well. And so what the stock market, I think, is finally coming to realize is that with this is that this could be a failed move, and they're not all sunshine and roses. Now, if the Republicans keep at least the Senate or the White House, either or, at least there's a foil out there to stop any kind of massive tax increases in that regard. So that should stabilize this, because there is so much Federal Reserve money sloshing around that we should still be going up. It's just there's so much out there. But I think what we're seeing now is that the large institutional investors, they're seeing this and they're saying, hang on a second, this was the high in February of this year. We broke out, and now they started to realize, and now we're below that high. And so that's why you're seeing in many of the accounts, different pieces have been taking off. They sold a bunch of the gold stuff several weeks ago. Other stock pieces have been sold the last several days. And that's what you're seeing is this thing, if it starts to unravel more and more, you're going to see more and more stock pieces get sold, just because you just don't know where this is going to end. The problem really is that of all this is that right now, the Federal Reserve, the money that they injected into the economy in March and April has really led to a runaway valuation problem that we're having. Right now, the stock market is the most overvalued it's been in a lot of ways in the history of the stock market. Warren Buffett has famously used what's called the Buffett yardstick. He didn't create this thing, but essentially it is a way to measure valuation of the stock market. And what you do is you take the total market capitalization of all the companies that are publicly traded. So you look at the Wilshire 5000 of all companies that are publicly traded, and then you divide it by the gross national product or the gross domestic product of the country, and it tells you how much am I paying for the stocks in relationship to the economy in which they operate. Because generally what happens is as the economy goes up, stocks should go up and vice versa. But sometimes they can go really extreme and far and away what the economy warrants. So right now, and this is a chart from 1947 through a few weeks ago, what it's telling us is that the market cap to GDP ratio is about 227%. And what that means is it costs 227% of our gross national product to buy the stock market. We've never been higher. The highest we had before this swing was in February, but then the highest before that was 2000. So essentially what's happening is that all this extra money from the Federal Reserve is in the system, and it's going into the stock market. It's got nowhere else to go in a lot of ways. And so the problem is that we are significantly overpaying for stocks in relationship to the economy in which it operates. So 227% of GDP is what the stock market currently goes for, or GNP. And so that's an issue, because if these things start to unwind, they're going to unwind quickly, and that's why you're seeing stuff come out of the stock, the different accounts quicker than we would typically see it, because people are starting to get worried that valuations are starting to matter. Just another indication of sky high valuations in the stock market. The Russell 2000 index, which is an index of essentially not exactly 2,000 companies, but close to it, all the small caps, smaller companies under $2 billion of total market capitalization. And so as of last week, the company Apple by itself is worth more than all 2,000 companies in the Russell 2000. It's obscene. Also, Apple right now is worth more than all the companies in the FTSE 100 index, which is the London Stock Exchange. So Apple is extremely overvalued. Well, I don't say overvalued, but extremely valued compared to both small caps and things outside of our country. And this has never happened before, where one company has made up is great. One company's stock market capitalization is greater than the small cap index of 2,000 companies. Just unreal. And so again, that speaks to problems valuation wise. And really, at the end of the day, the reason why it's happening is all this extra money is out there sloshing around because of the Federal Reserve, and the large institutional investors, they prefer large liquid companies because they're buying in big bulk, and that's why you're seeing these kind of things. Unfortunately, these things tend to unwind, and they tend to unwind painfully at times as well. I found this on a website called Seeking Alpha. The source is at the bottom of this. But interestingly enough, there is a total market index. The S&P 500 has a total market index. There is an ETF that tracks it, ITOT, right here, that you can buy. And essentially, it is the Wilshire 5000 of every company that's publicly traded in America, and it buys them in a market capitalization weighted scheme. And of those, all those companies in the S&P 500 total market index, 65.2% of those stocks are down for the year. So that means of the 5,000, 3,600 or so are negative for the year, and only about 35% are positive for the year. And what that's telling us again is that there's a very much a dichotomy in what's going on in the stock market. So right now, the year-to-date returns, if you look at all these companies, all 5,000 companies in the total stock market index, the companies that have had a greater than 7.5% a year-to-date return down here in this chart, there's over 1,000 of them, but their average market capitalization is $21 billion. For the companies that have had a 0 to 7.5% return year-to-date, there's only 258 of them, and their total market capitalization is $16.3 billion on average. And if you have had a 0%, less than 0% return for the year, there are 2,377 of those companies, and their average market cap is $5 billion. So again, what it's showing us is that the returns so far this year in the stock market are highly skewed towards the largest companies, and the smaller companies where normally you see the largest growth, it's not happening. So again, usually what happens when you have a major decline and you come out of a recession, the small caps lead for a year and a half or so because the valuations are so cheap. What it's showing us here is the large institutions want no part of the small caps. And the only companies that are going up are the biggest companies, the Apples, the Amazons, NVIDIAs, and that sort of a thing. And the smaller companies that are more in tune to decent value, they're just languishing again because the large institutions can't get in and out of them. So again, that's a problem because the large institutions, they can buy quickly, but they can also sell just as quickly. And so that could be a problem down the road too. I apologize for the blurriness of this chart, but I thought this was interesting and I wanted to share this with everyone. This is actually a chart from July 24th, but the point is still relevant here. This is a chart from 1909 through July. And what it's showing here is that the orange line is the PE ratio at the start of a 10-year period. And then the green line, the green bars, I guess, are the 10-year return at that point. And so the problem is what you're seeing is that the PE ratio at the start of 10 years, so the PE ratio at the start of 2006, 2007, 2008 was extremely high. The average PE ratio of the S&P 500 was above 40, and the 10-year return at that time, if you put your money in the market at that time, was zero. Same thing here in the late 60s, before we started having the problems in the 70s with stagflation. High PE ratio. PE ratio is a price to earnings ratio. So it's the price to earnings. So the higher the value, higher the PE ratio, means I'm paying more and more for the earnings. And what this is telling us here, and this is actually 1938, it looks like as well, that the higher I pay for earnings, the more I pay for earnings, it actually has a dilutive effect on my 10-year returns. And so right now what it's showing us here is that, again, you put your money in, you got to wait 10 years. The problem is that the PE ratio is in a very high percentile in relationship to past history. And the PE ratio, the average PE ratio right now, the S&P 500 is right at about 30. Typically, when you get above these ratios, above 25 or so, the 10-year returns are slightly positive to maybe even negative. So what this means then is that we probably, because the Federal Reserve has put so much extra firepower in the system with underwriting different things and doing all sorts of things, we probably have a ways to go on the upside. But this isn't going to, you can't buy and hold anymore. This just means that we significantly are overpaying for earnings right now. And eventually, when the sugar rush of what the Federal Reserve has done wears off, we're going to have to pay the piper. Now, again, in my opinion, what's going to happen is if the Republicans, and again, I'm agnostic when it comes to parties, if the Republicans can keep government divided in some way, shape, or form, we probably got about 2 good years before we take off and blast off and do what we got to do, because the sugar rush of the extra money in the system will be helpful. But eventually it's going to unwind. And when it does, the next big correction we have, which I don't think we're going to have it yet, but I think the next big correction, maybe 1 or 2 years down the line, is going to be significantly painful, more so than we have seen this year, unfortunately. But again, what this chart essentially is telling us is that the PE ratio is so high, the average daily PE ratio is so high compared to history, that we should expect the stock market to underperform going forward in the next 10 years as opposed to overperform. Also, this is interesting as well. This is a chart from 1938 over here through a couple weeks ago. This is from a group called RIA Pro, but it's just showing that normally value, the 10-year total return, value outperforms growth over time. The only time it didn't outperform on a 10-year basis was 1938 over here, and then from about 2010 till now. Statistically, what usually happens is that value outperforms growth in the history of the stock market. And we're starting to see some of that unwind right now, where some of these things like Tesla are unwinding, and even Apple to some extent as well. But eventually we should see value revert back to being a leader as people start looking at, well, what am I paying for and what am I getting? But this is very unusual to see growth just kind of take off and lead this long. Also, what's interesting too is that a lot of the folks that we follow are saying that the cheapness of commodities in relationship to everything else is significantly undervalued, And maybe it's about time to start looking at commodities and commodity stocks. That would be gold, it would be energy, it would be other things. And the reason why it's important is if you think about it, the national debt that we had before the COVID crisis was about, I think it was $17 trillion. Our national debt right now is $26 trillion. So the COVID crisis has actually added $9 trillion to the government debt. The problem is that the government essentially just prints that money. There's no other way to do it. They print it by issuing bonds and doing other machinations that they get involved with. But if you think about it, that should mean that the dollar over time becomes worth less and less. Because as you print more and more dollars, there's more and more dollars chasing certain assets. And so it can lead to inflation, but it also means it takes more dollars to buy certain things. And that's why you're seeing gold move up. And so the problem then is with the dollars is that we should see gold eventually get extremely high, because the last time we had this kind of printing press with the dollar, it was the kind of the penultimate time for gold, because again, gold is nothing more than an alternative to the dollar. And the reason why the large institutions tend to like gold is because they know that the government can't print any more of it, and it's a way to store value. So we may actually be seeing a time period here where gold is the best option for investing for a long, long time as we move forward, at least several years. Now, where does that leave us today? This is another chart of the S&P 500. It says index, but it's just the S&P 500 over here on the left side. This is February and March. I'm sorry, March and April right here. And then here's the blast off, and then here's June, and we took off. And so this is from our good friend Avi Gilbert, who is a well-known institutional trader and money manager. And he was pointing out is that what should happen, because of all the extra and excess stuff floating around in the system for Federal Reserve money, is that we should catch some support here in the S&P 500, which should be somewhere around 3,200 on the S&P. Then we should get a bounce, and then we actually may, because of the election, may see support down here at about 2,900. And he believes we're not going anywhere lower than that. In fact, we may only get up to about 3,000 at the low on the swing down, because again, the Federal Reserve has printed so much money that it has to go somewhere. And so if the Federal Reserve hadn't done that, we would be looking somewhere down here, which is the lows from February and March. But again, what he is advising all of his clients is that if we get into this box, which is somewhere between 3,200 and 2,900, this is where we want to start buying aggressively, because there is so much money out there, and based on support and cycles, that this is where we should catch a bid, and then we should go up from here for a year and a half, 2 years, and then we worry about it from there. And so the key thing is that we shouldn't be seeing the lows like we saw in March of this year. We shouldn't revisit those. But we shouldn't be surprised if we spend some time down here at about 3,000 or so in the S&P 500. But it's going to be a buying opportunity. It's not going to be a time to be heavily selling anything as we go down there. So key thing on that. And we'll skip that one. But the idea here then is to be mindful of the fact the election is going to drive everything going forward. And really, the hard issue we're going to have is that we're not going to know who the true winner of the election is on the end of November 3rd. I believe that's when the election night is. We're not going to know who the true winner is. And we could have weeks and months of hanging Chad discussions as people try to figure out who is the winner. So the key thing is, the main thing I wanted to reach out and show you this is that even though we are seeing some deterioration and some pullbacks, and we're seeing stocks and different ETFs and pieces come out of the portfolios, don't get too alarmed, because again, what the portfolio managers that we follow are saying is that this area here, about 3,000 on the S&P 500, should be a major buying opportunity before or after the election. And because, again, there's so much Federal Reserve money out there, we need to be mindful of that, and it would be a good time to invest if we get that kind of correction. So again, if you have any more questions, just feel free to reach out. Again, key thing is that don't get too worked up about what we're seeing here. There again, there are going to be buyers coming in here. We're not going to get too much lower from this point. There may be some more things coming out of the portfolios as they reposition. But again, I think we're positioned well. And most of the folio portfolios were even more defensive as well. But I think you'll find that we're going to have some downward pressure through the election. And then after the election, if we find out that there is at least going to be split government in some way, shape, or form, we should be okay. So again, we should see this should be our first holding of support about 3,300. We should get a bounce up. And then if we drop down here to about 3,000, this is where you'll probably see the portfolios, if you see institutional buyers coming in, where they'll start loading up again. So again, nobody's really selling yet. There's just not a lot of volume out there. So again, if you have any more questions, let us know, and be happy to have a chat. Have a great day. Take care. Bye-bye.